Good morning, everyone. Thank you so much for coming back. This is our day 2 at the Harvard Blockchain Conference. And today, I'm gonna welcome you our first panel, the Institution Crypto. I will hand the mic to Stefan.
Hi, everyone. Thank you for coming in on an early morning Sunday and being with us for institutional adoption of crypto. Just a little bit on myself. My name is Stephen Shi. I work at a company called MPCH. We're providing the security infrastructure layer for private key storage. It's really cool to be back here. I graduated from HBS last year and was a part of the organizing committee for the conference last year as well. And so this time I get to just come and talk to people and not get involved with any of the logistics, which is great, but excited to see where everything has come in the past year. So maybe I'll just go around the table here and would love to hear about everyone's backgrounds just so the audience knows and the companies you work at.
Great, thank you. Nice to meet everyone. My name is Josh Deems. I am the Institutional Business Development Lead at a company called Figment. Figment is a staking as a service provider based in Canada, but we have operations and team across the world as a fully distributed company. I'm based here in Boston, so it's great to really not have to hop on a plane to participate in a crypto conference. And I previously spent time at Fidelity helping build the Fidelity digital assets business. And before that, spent time at State Street. So I've seen kind of the development of crypto from an institutional lens, and it's now really fun to be at a venture-backed company building and bringing Web3 to the masses. So looking forward to diving into that all with everyone today.
Hi, everyone. I'm the other Josh on the panel. I'm Josh Burek. I'm Senior Director of Strategic Positioning at Circle, issuer of one of the world's largest payment stablecoins and, in our view, the most trusted. I've been at Circle for 2 years. I actually left Harvard to come to Circle. I was over at Harvard Kennedy School, and I bet within the world of digital assets, I'm the only Harvard Divinity School graduate in crypto. I'll let you make of that what you will, but it was fun to be back coming through the Divinity School campus, and it's great to be part of this panel and to be with you today.
Great to meet everyone this morning. My name is not Josh. I did not go to Harvard, so thank you for welcoming me. My name is Hadley. I actually went to RISD many moons ago, whose origins to crypto assets and blockchain technology I'm not quite sure about, but here I am. I've been involved in digital assets, crypto, call it what you will, since 2014, where also with Josh, I was part of the very early team at Fidelity Digital Assets. After that, I was in the startup world, and most recently I was Bank of New York Mellon, where I led their entree into digital asset custody for institutional clients for Bitcoin and Ethereum. That's led me to co-found a company called Cold, which I can talk a little bit more about. But Cold is focused on institutional grade bank level custody for digital assets as public blockchain value goes from 2 trillion, approximately, depending on the market, pegged to public blockchains, to 10, 20, 30 trillion with the onboarding of real world assets and other types of assets to public blockchains. So great to be here this morning.
Awesome, thank you. And so I think one topic to kick off with, clearly ETFs have been a big narrative in this past cycle, arguably kind of the catalyst for the boom that we've been seeing. And it's kind of gone under the radar despite its historic launch. But I want to rewind a little bit because we have 2 folks here who were part of the early days at Fidelity, who's also spearheading the foray into ETFs. So, Hadley and Josh, I'd love to get your perspective when you were at Fidelity pitching this as a concept. What was their vision for digital assets? They know they wanted to eventually get to ETFs. And how were you able to get the senior management buy-in to do something that was so kind of crazy at the time?
I'll kick it off. It was easy to get senior manager buy-in at Fidelity because Abby Johnson had such strong leadership and vision in this space. So I was actually voluntold to head up the Bitcoin incubator in 2014. I cannot claim any intellectual, justification for my involvement. So that was easy. I think if I recall correctly, an ETF was one of the early things that was written up on the board in that time. So the buy-in was easy. I think what was hard, and in an irony, in many ways Grayscale helped kick this off with fighting the SEC. That was the long battle. But Josh was there, longer than me after, so I don't know if you have any insights on the ETF.
I think what Fidelity did was really interesting. So if you look at the service provider stack at all of the other competing ETFs, you see like Coinbase is generally the custodian. A lot of the infrastructure was outsourced, and Fidelity was so early that they actually built the infrastructure themselves. So Fidelity built their own custodian, they built their own trading venue or execution services platform in order to ultimately service an RIA and retail trading audience, which is who Fidelity services in their other business lines. I don't know really if the end goal was to build an ETF. Fidelity historically wins on the retail brokerage side, and they win on the RIA side. But BlackRock is historically the largest ETF provider in the U.S. at least. But I think being a funds company and having the infrastructure in-house, it was sort of just like a natural building block of how do we take this infrastructure that we built and put it on rails that becomes accessible to folks. And so that's really what the end goal ended up being. But I give a lot of kudos to Fidelity early on, just having a lot of conviction, especially, if you look at what happened, even, this is after Hadley and I were gone, but post FTX, when a lot of large institutions slowed their plans down or decided we're no longer going to build this in-house, we're going to outsource it. We don't want the risk internally. Fidelity continued to build and launch and scale products. So I think that's a testament to the conviction. I partially think, we had a really good team of strong believers up and down the stack, which makes a huge difference when you're trying to scale something at an institution.
No, yeah, that makes complete sense. And maybe for members of the audience who haven't followed this entire journey, any commentary on, this was years in the making to get the ETF approved, kind of the regulatory or policy battles along the way, and kind of where do you see the state of regulations in the US as it relates to assets on chain, whether they're crypto native, stable coins, real world assets, that sort of thing, and where do you see all of that going?
Yeah, what a lost opportunity for Washington. I think everyone up here would agree that digital assets is far more than a speculative industry. This is a strategically important technology arena, like 5G, like quantum computing. And Washington has an opportunity to be a leader in a strategically important tech arena, but it's not. It's been content to be a follower. And as we walk around the world, other financial hubs aren't waiting for Washington to act, whether it's Hong Kong, Japan, Seoul, and particularly Singapore. Even France and the EU are well ahead of where Washington is. Now, as I say that, I think it's important to recognize that there is, if you talk to individual members on both sides of the aisle, there is bipartisan recognition that certainly stable coins and other digital assets are too important to ignore. And it represents vital upgrade to our global financial infrastructure. So I think the will is there. I think the recognition is there. I think now we just need the stars to align so that we get real, strong federal standards.
Yeah, I can just say, being a global company at Figment now and having to operate in different jurisdictions, it's very eye-opening to see what the different regulatory stance is at different regulators globally. And I think one thing, I used to live in DC, and part of what I was doing at Fidelity was helping just do general regulator education. And it was actually really fascinating, meeting with, kind of junior and mid-level staff. The education was always there. I'd walk into a room and be prepared to explain, the difference between proof of work and proof of stake, and people understood those definitions. I think it's just, there's a lot of, there's a lot of distrust and for good reason in what crypto could potentially become. And I think, you see what's happened over the last couple of years with companies that were well funded in the United States, backed by people who have connections, and seeing those companies, the CEO of that company go to jail for 25 years does not give a good feeling, I think, in the general in the general atmosphere. And so I think there's just it's almost similar to the stance at, a large global bank, right? If you think about like the US regulatory position and a large global bank position, the stance is always going to be, we're interested, we're watching, we're believers in the technology, we're not totally bought into the application of trading systems and the assets and the underpinnings of it just yet. Agree with you, Josh. I think it's a missed opportunity to be a global leader, but I don't think it's going to. I think once the U.S. and we've already started to see it. You see the ETF inflows into the U.S. products; they're massive. I think once we start to see some more comfort from the SEC, from the OCC, we're going to start to see a lot of innovation happening here, and don't believe that this is going to be the permanent stance of the U.S. government.
Yeah, I think what's interesting about this space is we tend to sometimes think that regulatory only applies to institution, or it's something recently. Bitcoin, which was the invention of public blockchain, go back and read the white paper, was in many ways a salvo to our regulatory financial services system. It was much a political document as it was a technical document. And so one of the things I enjoy about this space, although it's kind of stressful and it's kind of weird sometimes, is all the different viewpoints and different way that people come to how we should use this technology. So libertarian, or degen, or we should have a regulatory layer. This is one of the things that's really interesting and very challenging about this space, is what is money, who controls it, all these sort of fundamental questions. The only thing I'll add and close with is I agree with Josh, and Josh as well, but in this case, this Josh, that the regulators are much more educated. When I started in 2014, it was very basic. Now they understand, and I think because they understand, there's just a lot of fundamental questions about power, about control, or I remember talking to a regulator about issuing a bond on Ethereum public blockchain, a 20-year bond, and the question was, what if Ethereum doesn't exist in year 19? And that's a legitimate question of, is this going to actually be part of our infrastructure? Is it going to be shadow books and records? So the regulatory theme is I think some people pose it as a boogeyman. I think it's neither here nor there, but it's always going to be part of the conversation.
Quick follow-up point, Josh. You mentioned that skepticism of the crypto industry is not unwarranted, and I completely agree. It's worth zooming out to think about the emergence of all new innovations. Every emerging technology goes through this adolescent period where typically there are major issues around public safety, consumer protections. Think about the state of Tesla full self-driving. There's an interesting distinction with digital assets. Even the most fierce critics aren't really criticizing the underlying technology. The cryptography part of crypto has held up remarkably well, which is to say the math works, right? Most of the failures we've seen are related to just recklessness, fraud, classic failures of human integrity, which is a reminder that self-regulation is an important prerequisite to federal regulation. So don't count that as a morale boosting, but it is an important distinction that among emerging technologies, the fundamental promise of blockchain has proven remarkably resilient, and I think now what needs to catch up are all the layers of governance that need to attend it.
No, that makes complete sense. And I'm curious, on the regulatory front, it's obviously repeated ad nauseum. We need better regulatory clarity, et cetera, et cetera. I guess what in your minds specifically do we need clarity on? Because there's a number of different topics, whether that's SAB 121, securities versus commodities, et cetera, et cetera. Like, what in your mind, if we had a new administration, for example, we were able to flip a switch, would make the biggest impact?
Yeah, right now, Bitcoin and I'd say even other digital assets are kind of are not integrated into our traditional finance system. So, for example, big banks cannot hold Bitcoin or crypto on their balance sheet. They can't really use it as part of their, if you consider, as Josh was alluding to, this as a technology, you can't really integrate any of these assets into the operating system of a bank. So we were talking before the conference, I would actually say adoption of institutional crypto, apart from the the distraction of Bitcoin ETF and is at like 0.001%. Because these things, it's kind of, not that we want to equate ourselves with this industry, not that there's anything wrong with this industry, but it's kind of like weed and marijuana. Like, if you go to Denver, there are all these amazing buildings. Why are there all these amazing buildings? Because when it was first legalized there, that weed companies couldn't deposit their money in banks, so they built buildings. So I think the regulatory clarity is right now, fundamentally, if you talk about even a bank owning on its balance sheet or in its technical systems, like if we think about it as a protocol, like having anything related to these assets is toxic. So the regulatory clarity is, how can you integrate this technology into the operating system of TradFi?
I think the one thing that's going to help us through this next life cycle is sort of underappreciated. But the fact that we have futures that on Bitcoin and Ethereum that trade at a regulated exchange in the U.S. at the CME, that is how the regulators have ultimately got comfortable with price discovery for the Bitcoin ETF. And I believe it's ultimately it's ultimately the mechanism that they will look at for price discovery for an Ethereum product as well. So my regulatory wish list for the U.S. is quite long. I mean, obviously, personally would love to be able to use a stable coin from my bank. I'd love to, have access to be able to purchase, more than just a Bitcoin ETF in my 401k. And so there's a lot of things that have to happen from step one to step two. But I think we've made some strides, and I also think what the European Union has done with the introduction of MiCA is a great regulatory framework for the U.S. to look at. And I barring what happens in this upcoming election, that'll be the business case. That'll be what's studied. Does MiCA work? Does it enhance transparency, but also protect investors and also give people, companies an opportunity to thrive and grow? If those things hold up, then I think we could possibly see, something similar being implemented here. But yeah, that would be kind of a pipe dream at this point.
And just a quick grace note on the stablecoin side. Show me the money isn't just a great movie line. It should be a minimum standard for stablecoin operators. If you're claiming to be fully backed, you need to be able to show everyone why you're fully backed. At Circle, we have a web page that allows you to drill down into the serial numbers of the T-bills we hold. Right? It's that important. Stablecoins have a global circulating supply of $150 billion. Anyone who's in that market needs to be able to show you the money.
Yeah, that makes sense. I think we've been kind of going along this conversation with the assumption that institutional adoption is a good thing. If you look at the agenda of this conference, it's very crypto native, Web3 native. I guess to folks that might be wary of institutions dabbling into crypto, why is the kind of convergence of the two a good thing, kind of this Web 2.5, so to speak? Why is it good that large financial institutions are merging with crypto rails, and how's that good potentially for a crypto native community?
So I think there's a couple of different things. It's how capital flows through the global economy, and that's still through traditional rails. And we wrestled with this question all the time. I worked at State Street before Fidelity, and ultimately, like your point, Stephen, like the pseudo-anonymous founder of Bitcoin's goal was to sort of disrupt the banking system and rejigger the banking system and redevelop it in a way that completely changes the business models for these large banks. It basically makes them obsolete. That could potentially happen at 10, 20, 50 years from now. I don't think that's going to be the case. Global payment rails are still denominated and still managed by the top 5, 10 banks in the world, and there's really kind of not a lot of room to disrupt, a bank that has trillions of dollars on its balance sheet. When, as an asset class, we've barely scratched the surface. So, from a, I would say more of like a CryptoPunk, perspective, it's really interesting to see these companies like Uniswap develop and grow, and could potentially Uniswap at some point replace the New York Stock Exchange, potentially. I don't think that's going to happen within the next 5, 10, 15 years. So these large institutions are figuring out how do we make ourselves relevant in a world where our business models are constantly being threatened, at least conceptually, if not in materiality. So they'll continue to develop, and maybe, I think a good example is Coinbase. Coinbase developed what's now probably the second most popular layer 2 on top of Ethereum. And Coinbase is now, to me, an institution, right? It's a publicly listed company. They have a trust license. They operate an exchange, like all these different things. To me, that's a true institution. But they just developed the second largest layer 2 on top of Ethereum. So, we'll probably see more, like, there is value to institutions committing capital to develop programs and applications that usher in crypto. And I think right now that's what we're going to see over the next course of this cycle.
I think my mental model for this, and it's actually one of the reasons that me and my team co-founded Cold, is that this industry is like a tale of two cities, or it's two worlds. There's the crypto world, and then there's the bank level TradFi world. And both worlds, it's like they don't know what the others don't know, and they don't know what the others know, if that makes sense. And in order for this technology to really innovate and scale, both worlds truly need each other. The idea that crypto is going to just, again, respectfully, naively take over all of financial services and in fact become institution, what is an institution? It will become part of that is naive. And I think the idea that this technology will not radically change TradFi on the banking side is equally naive. So reflecting on my 10 years in this industry, I think that's where, at least, false modesty aside, myself and the team can bring a lot to this space of marrying these two worlds. I think it's an example of where a company like Circle is taking this head on, in that Circle is both very crypto native, right? Distributing these coins on multiple chains, really integrating with the system, but also holding cash at a GSIB bank. So that, to me, when I think like of an exciting career in institutional crypto, I don't think of going to work at a traditional bank and a research group and not building things. I think of helping define that marriage of crypto and TradFi, which is incredibly technically, product, regulatory challenging.
Hadley, I'm in violent agreement with you. I think the North Star word that comes to my mind when I think about the relationship between TradFi and crypto is not competition, but convergence. Circle CEO Jeremy Allaire says, we're not trying to displace banks, we're trying to complete them. Now, what does that mean concretely? Banks have been absolutely essential to financial security for billions around the world. But brick and mortar banks have also left many behind. There's about 1.7 billion people around the world who are under or unbanked. Let's take one market in particular, remittances. It's between $800 billion and $1 trillion a year. The average remittance fee of about $200 back to loved one's home costs $12. That's a 6% fee on the people who can least afford it. That's outrageous. We have the tools now to do that for a fraction of the time and for a fraction of the cost. So when I think about you mentioned a marriage, it's going to be combining those worlds so that people have a store of value and a frictionless exchange of value. And that's where I see these two worlds colliding in a very good social outcomes.
Yeah, and we started touching on this just a little bit with Josh's last comment, but where do you guys see are the greatest opportunities for institutions to leverage crypto-native rails in a way that completely changes their existing business models? I know we haven't really spoken about real-world assets aside from stable coins and tokenization, but I guess in your minds, what are the things that really excite you over the next 5 to 10 years?
Sure. Sure. So I'll share one proof point that we're really excited about at Circle. About a year and a half ago, the UNHCR came to us and worked out a partnership with MoneyGram and Stellar and Circle to deliver cash aid assistance to families displaced by war in Ukraine. Now, why does this matter? Traditionally, if you want to give money to a conflict zone, how do you get it there? Maybe you find a reputable agency, you hope that it actually got to the family, but was it siphoned off by a corrupt bureaucrat? What was the take rate? Did the family actually have the ability to access those funds? This is the beautiful thing about working with these new rails is you can deliver immediate fiat-backed cash assistance that's traceable, secure, virtually for free, instant, and it's corruption and censorship resistant. That's why the UNHCR is so interested in this technology, and the possibility to scale this up for humanitarian aid broadly stands because of crypto's unique ability to solve the last mile problem. This has bedeviled humanitarian aid for decades. And the idea that you can now trace this point to point, donor to recipient, is a really big deal. And I think that basic proof point also points to broader institutional adoption with cross-border payments, where the same issues are. I mean, who here has ever waited 3 days and paid $6 to send a cross-border email or a text message? It's an absurd question. We now all expect that our data, our communications can travel instantly, securely, and for free. But our money doesn't do that. Circle thinks it should.
I think the way that I think about this is almost at the tech layer stack, which relates to financial services products, like the way that value is exchanged. But I think what's interesting, we mentioned Uniswap, which is kind of a crazy, interesting thing. But back in the day, there was a company called Shapeshift where before regulatory powers got involved, you could, and I think the company name was brilliant, but the tech was brilliant. You didn't trade from Bitcoin to Ethereum. You pulled one down from the menu and you shifted from one token to another utilizing the public blockchain technology. So when I think about the interesting things that could happen within TradFi and institutions, I think about just like how HTTP or the web was applied to banking, how public blockchain technology or the infrastructure will be applied to the banking system and the financial system. There's a lot of overhead, there's a lot of cruft in the system, and the idea of the message is the asset itself is fundamentally very interesting, and the idea that these transactions, that value can be provably transferred through software and software alone without third-party intermediaries, that was one of the first reasons why Fidelity got involved in this very early on. Fidelity is a multi-trillion-dollar business. There's lots of people and software. What is it fundamentally doing? It's helping track and transfer value. What does the Bitcoin blockchain do? It does that. It's not a company. It's not even that big of an entity, and even some of these other public blockchains are. So I think that's why we're really, really just getting started in how this technology could disrupt financial systems.
Yeah, Hadley, I'll just tack on a little bit there. One of the things that interests me, I admittedly found the space and dove down the rabbit holes of Bitcoiner, and now work at a company that really doesn't do a whole lot with Bitcoin. We're a staking provider, but I think about, we've talked a lot about like the rails and the existing banking system, the financial system. I think what's really interesting is also the operating system of the crypto economy that's being developed, and a lot of the rails being put on something like an Ethereum or a Solana that has the ability to transfer value near instantaneously. If you're trading meme coins on Solana over the past couple of days, it's been a little bit slower, but normally it's 60,000 transactions per second is the throughput of Solana, and whatever the use case, I just joked about meme coins, but whether that's meme coins, a tokenized bond like what BlackRock is doing, tokenized money market fund, you really, you can build whatever you want and put it on top of these rails. There's no discrimination in terms of what's being built. And so underpinning all of that is a brand new operating system of the internet, and a way to transfer value from one person to another without using a lot of the existing fee-taking, kind of middlemen. I think what's really interesting there, and a lot of the institutions we talk to, is it's a little bit more on the investing side, but you now have the concept of a rate, right? You have a rewards rate underpinning a number of these proof of stake protocols that you can plug into your traditional DCF model, right? You have what's the equivalent of a risk-free rate. It's not risk-free, but you have something that's a good proxy for it. One of the challenges in the earliest days when we were at Fidelity is, how do I value Bitcoin? I don't understand how this thing has value. It's intangible. I can't hold it. How do I know there's ever going to be 21 million? I can't audit code. A lot of that work has been done and kind of, being able to see things at least at like a block explorer level. But from an Ethereum perspective and from a proof of stake perspective, being able to participate and secure these new networks, I think, is really powerful. And it brings in a new way of participating in a new economy. So I think we see a lot of institutions participate in that space. I think we're going to see a lot more over the next couple of years.
Yeah.
Can I I think what's interesting about Josh and Figment as well is like the idea of like staking, which is a technology, right, then becomes adopted and is part of an institutional, operating system. And then what is staking? It's validating the network, validating transactions. So that's what I think is so interesting about how this world will change, right? Is the technology starts, there was a big shift from proof of work to proof of stake, which seems like a tech piece, but then companies like Figment are leading the charge on then how that translates to other part of the financial system. And I think that's just a glimpse of the very beginning of what we'll see, where there'll be this mix of technology and business and different participants.
Yeah, so we touched on it a little bit. We are all working at companies that are working very hard to push the boundaries of innovation and technology to get to this promised land. I'd love for you guys to talk a little bit about what from a technology perspective we should expect to see in the pipeline. We talked about our wish list of regulatory and all of that. The rails are mostly there. There's probably going to be some additional innovation on the layer 2, et cetera. But in terms of the picks and shovels, enabling the institutional adoption on technology, what are you guys working on at the moment that we should all be excited about?
Hadley and I were chatting this morning about trying to date where we are in crypto development in terms of internet history. Are we at 1974, 84, 1994? And I think I agree with you that we're essentially pre-browser. For those of you who were using email then, in the 1990s, imagine if a Yahoo user couldn't email a Hotmail user. The utility of email would be fairly limited, right? The idea of walled gardens with email would put a big constraint on what we could do. So one word that comes to mind is interoperability, and its close cousin, programmability. One big thing Circle's excited about in the past year is the launch of CCTP, the cross-chain transfer protocol, which is a step toward interoperability. But I think anything technologically that takes us closer, and I know Chris Dixon's here and going to be talking about this later. His book is fantastic. History and insight about the power of protocol networks and the protocol networks in a contest of centralizing internet networks. So I definitely commend you to stay and listen to that. But I think technologically, the more that we provide, the more that we can break down barriers of walled gardens, then we're driving in the right direction. And I think that will only accelerate adoption.
I'll just quickly add, I think it's like, Stephen, you mentioned layer 2s. I think it's outsourcing, the way I think about it, it's outsourcing the security budget of networks like Ethereum and Bitcoin, who have, Bitcoin's a nearly $1 trillion asset. Ethereum is a few $100 million. Using the settlement finality and the sort of weight of those networks to build new things on top of, we're seeing happen in spades. And that's where the venture dollars are coming into this space. That's where a lot of our clients are interested in participating. From the Ethereum side, there's a new concept, we don't have to go down this rabbit hole right now, but called the eigenlayer, which is restaking on top of your previously staked Ethereum position, which is going to allow for new applications and a new network of participation, a layer up on top of Ethereum, making it less expensive, but also, more data becomes available to you. So that platform works because it's using Ethereum's security budget, because Ethereum is such a large backed. There's so much capital in that system, and it's it's basically impossible to rewrite that blockchain. So because of the comfort in Ethereum as a base layer, a lot of things are being developed on top of that. We're seeing that now happen with Bitcoin as well, which is very interesting. But basically taking Bitcoin's security budget and building new layer 2s on top of that, which will make, as opposed to Bitcoin transactions which settle in 10 minutes, settle near instantaneously, while you still have a lot of the same security promises that you get when you're transacting on top of Bitcoin. Very interested to see kind of the Bitcoin layer 2 space develop. But I think taking base layer, kind of stalwart blockchain protocols and building things on top of them while using them at the base layer for ultimate settlement finality, I think is where we're going to see this next cycle really take off.
Yeah, I think all those things are true. At my particular piece that I'm hoping to add to, or will add to over the next few years with co-founding Cold, which is a bank-level custodian, goes back to one of the unique challenges of this technology, which I'm sure you've all experienced, which is key security. So I've done it a couple of times, once at Fidelity, once at Bank of New York Mellon, and the team and I have a very clear vision that once this technology is adopted truly by TradFi, security and key security is going to be a whole other level of magnitude of importance. So you may argue it's somewhat boring, and some days I think the rabbit holes get kind of deep, but it's a fundamental aspect to the security. If these bearer assets are really going to succeed, and if we're really going to say it's not a database that someone can go and unwind manually, the world's economy runs on open blockchains, public blockchains. How that key is generated, how that key material is secured, who owns it, who has access to it, is going to be a fundamental part of this system. So that's the layer that my team is working on, at that layer, but I think that layer enables all these other things, because once that's done at the point where a regulator can feel comfortable with that being part of our financial operating system, then all these kind of other creative things and innovations can take place.
Awesome. Well, I think we can wrap there. Thank you all for your time and insights here. I think it was a really fascinating discussion. So I guess we'll see you guys in the classroom next door. Thank you all.
Thank you all. The Q&A session will happen at 1:08. Thank you all.
Hadley? No, we did a little bit.
That was good. So did we go